Okay, we're going to get started. All right, so we're going to look at the homepage of Yahoo Finance. It's one of the best websites for current news. We can see that the stock market is up a little bit today. We're actually down for the week. So we're starting a basically topping pattern in our stochastics. You can see that anything above 80 is overbought. And we've been at an overbought state for at least since September. So it's been a couple months. And it seems like, well, we don't know how long it's going to stay overbought. But usually what happens is we're going to go down to the bottom of this range next. So don't be surprised if we go down like 3 or 4% and hit this bottom of this trading channel. All right. So we actually started the week like 1% up from where it is now. So let's look at some of our calendar notes. This is the beginning of earnings season. We've had the banks come out with earnings. They were really good. Tesla came out with earnings this week and yesterday, it was 2 days ago, and they were really good. They went up 22%, which is pretty good. Now we're going to have in the next week, we're going to have Waste Management, Google, Visa, Microsoft, Meta, um, Apple, Amazon, MasterCard. So it's a major week of earnings coming up. And I have it as red as green here because October is traditionally a positive month. We're actually, you can see this is one of the better months of the year. And November is traditionally one of the better months of the year we're going into. So remember, we have holidays of Thanksgiving and Christmas and New Year's and these this time periods. So a lot of times when people are on vacation, um, people are a little have a better attitude, and that helps the stock market. And a lot of the end of year things go on with pension funds we don't know that make the stock market go up. So so we have a couple other things to look forward to. The election. Um, if we go up in the stock market to the election, this election could be buy in a rumor, sell on the whole on this buy in a rumor, sell on the news. To remember that anytime there's a report that's supposed to come out and it meets expectations, like if we have an election, and right now Trump is the front runner, is the leader in the polls. If Trump wins, then we have um, most likely selling in the stock market. So buy in a rumor, sell on the news. So we're going to have major earnings coming out in the next week. Uh, we don't know what's going to happen, but we've been given hints of what's to come. We know that Google, Microsoft are spending, and Meta are spending heavily on NVIDIA's chips for their AI ambitions. So any spending that's out of line that Wall Street doesn't want, they could be hit with profit taking or some kind of sell-off. But we'll see what happens next week. But that's going to be a major um, week of earnings. We have the Fed meeting in November 6th and 7th, and they're saying that there could be a quarter interest rate point cut, and um, and then after that, it's the same thing. We could have a buy in rumor and sell on the news. So watch out for that. We have NVIDIA earnings coming out at the end of November. They're always reporting later than other companies. Um, so we also have we have the Thanksgiving holiday, the 28th, and Christmas. A lot of times the stock market goes up around the holidays. So remember that. And we have the Fed meeting again in the middle of December. So a lot of these are things to keep in mind. Uh, So if we, let me see what else. Yeah, that's all I really had to say for that. All right, now let's look at some of our talking points. The S&P is down around 0.5% to 1% from last week. Um, we're starting to lose momentum in the stock market. The only 60% of S&P stocks over 200-day moving average. So last week it was 79%. So um, it's a big change, you see. So what else do we have to say here? Okay, so the treasuries, this is the big news of the week. Treasury yields have gone up 2.5%, basically on no news. So we're left to speculate why. Look at the interest rates on the 10-year. Again, this is a lot. 0.014 is a lot to go up in a day. So there could be multiple reasons for the US Treasury going up. It could be that there aren't enough buyers. It could be that there's people in the bond market positioning a certain way and they have to sell their positions or whatever. So there's a lot of longs and shorts in trading, and sometimes resolutions to trading imbalances makes um, yields go up or down a lot. Also, we could interpret this higher yields as people fearing if Trump gets in as president, then there's going to be high inflation. Um, and then we might have issues with our debt if we have to raise interest rates. All right. So let's look at some more talking points here. All right. Okay, our theme from the beginning of the year was revert to the mean. Healthcare, telecom, financials, energy, utilities, and biotech did worse last year. Will do better this year and return to the mean. Also, the PE of the S&P is around 22 now, and over time it'll revert to 15. So we have to constantly be ready for any kind of correction that allows the S&P to go back to a normal 10-year average. Companies doing great in this environment. Companies that do not need to borrow, especially with interest rates going up. Right now, with the 10-year going up a lot recently, you're going to have to focus on companies that don't need to borrow and whose earnings estimates are increasing, and companies possibly some contrarian plays. Like at the beginning of this year, we had this contrarian mindset, and that's worked out pretty good this year. So we're also looking for stocks that drop for no reason. That happens a lot. Let's look at, we're going into one of the best seasonality wise months of the year. So we are overbought right now, but let's look at, we are overbought, but traditionally we're going to have a good month. Let's look at the S&P's trend lines. You can see that this is one of the best behaved trend lines we've ever seen. You can see we're hovering over all the moving averages, and the green, you can't see it, this green line right here, this is the 150-day moving average. This is really important because you can see it's the bottom of our trend line right now, basically. So any sell-off in the stock market will most likely go down to this 150-day moving average. And you have to remember that, because if you get in a situation where stocks are falling and you don't know what to do, and you have to keep in mind these support mechanisms in the stock market. Every person trading that has a lot of money knows that there's support at the moving averages and the trend lines. So that's why you got to follow that too. All right, so like I'm under the understanding now that we're always going to have an inverse correlation, the S&P 500. We're going to go over a little bit later why. Basically, the reason it's companies, the less they're going to grow. So the multiple you pay for them goes down. And and right now we're going to go over, okay, this is basically, we've had an inverse correlation for a while, and I think that will never go away. We had like a couple anomalies recently with the Fed reducing the interest rates, but in general, we can still look at the the 10-year and the 2-year Treasury and know if this goes up, that's bad for the stock market, and the stock market will most likely go down. And if it likewise goes down, that's good for the stock market. So, all right. So let's look at our major variables in the stock market. Um, Oil is unchanged from last week. What can we say about oil? We have a new president coming in. A lot of things are in the market right now are marking time, waiting for the new president, the new Congress. Um, After the election, we'll have a lot more certainty about possible drilling practices that's allowed. We have a lot of things that are going to change after the election, but right now, I think um, oil is an example of one thing that is basically marking time. We have inflation is 2.44%. It's not unchanged from last week. We have the US dollar is up just a little bit, but it's in a downtrend right now. And gold is up 1.5%. Gold is probably up because of the demand imbalance. We have, let me see. Okay. So stronger US dollar tends to drive gold prices lower. That didn't work this week because we had a weaker dollar, and that should make gold prices wait. Stronger US dollar tends to drive gold. Well, so we have a stronger US dollar this week. That should have made gold prices go down, but it didn't. So it must be a supply or a demand issue. So probably a lot of central banks are buying gold right now as a risk to, as a hedge to problems with currencies going forward. That's probably what's happening there. And we can see the dollar index is going down. Okay, fear and greed index. We have people are less greedy than last week. We had extreme greed um, earlier this week. We're back down to greed. So people are getting a little bit more fearful as we hit all-time highs. Um, let's look at the AAII survey. So the amateur individual investors are basically, this is pretty close to even. They're bullish 37, 32, 29, 30. So the amateur investor is getting more bearish, actually, but they're still bullish, not by much. So bullish means caution, take some profits. Okay, let's go look at the VIX. The VIX is actually 19. So people are pretty complacent. They're not buying protection right now, really. And they think that there's a good market that's safe. Okay, so in our emotional chart, we're in greed right now. Greed is one step from delusion and craziness. So people are still excited about the stock market and they're buying. I highlighted some really important things that could make the stock market crash. Um, any kind of downgrade of the U.S. debt. Let me see. So right now we have a good portion of our GDP going towards debt. The debt increases 1 trillion every 100 days. I'm going to go over some a very important investor that talked about this. It could be something that we could kick the can around for 10 years and still have the same problem. Or any day now, we could have the United States go bankrupt if we had. The reason is we have a lot of debt right now. If we have increasing treasury yield, for instance, if the 10-year went up to 20% interest, we would spend more in servicing that debt than we were making in GDP. And when that time comes, we'll declare bankruptcy or something. I don't know, and that would be a huge issue. Um, okay, the other thing is we don't know what the election results will be. So if there's a one-sided win one way or another, that could cause the stock market to correct because if there is, let's say, all Democrats in um, elected, then and for the House and well, for the Senate and the House, then we have laws that will be passed, and that will mess around with the business models of the businesses. But we're rooting for a split Congress, meaning there's not going to be any laws passed, and that keeps things the same. And that certainty is what the stock market likes. All right, so interest rates. Um, we've seen little hints that there's a inflation, a possibility of inflation sticking around. So keeping rates higher for longer or raising rates could cause a stock market crash. And that's it for now. All right, so let's look at our worst to first we've been tracking since the beginning of the year. Worst sectors last year are utilities, consumer staples, energy, and healthcare. Um, and this year, utilities is second best of the year sector. Consumer staples is doing pretty good, and energy is one of the worst performers. In real estate, one of the worst performers. So, so energy could be on the bingo card for next year outperformer. Let's look at because it's been outperforming for 2 years now. Let's look at some of the other things or themes. AI revolution is still a good theme. The build out of data centers that is seen in the utilities sector, demand for electricity in utilities, cyber security, and of course utilities such as electric companies increasing demand for electric. Okay, so what else can we see here? All right, let's go look at the market movers for today. Um, okay, we can see from the S&P, the one up the most today is Tapestry. They actually were going to merge with the they were going to merge with a company. We'll see the ones going down the most today too. And it was ruled that it can't go through with it by a judge. And a lot of times, whenever you're taking over a company, your stock goes down, and the takeout company usually goes up. So we have a situation where you see, let's look. Okay. All right. So let's look at the other stocks that are going up today. We have a lot of financials in here. We have Discover Financial, Capital One. This is a takeover issue. Capital One wants to take over Discover, and then there's some government action saying that they might not be able to do that. So let's look at what else is doing good. Digital Reality Trust. They're a company that's involved with data centers. So they do land for data centers um, for the AI build out. The one's doing the worst today. Let's look at the to keep all this in mind. Let's look at the Treasury. Okay, Treasury is going up. So um, anything involving housing, interest rate sensitive sectors will be going down. I made a cheat sheet for this just so we can keep track of this. Okay, rising yields. So today we have rising yields in the 10-year. That's positive for large tech stocks because they will excel. They don't need to borrow money and they'll have an advantage over other companies that need to borrow, such as smaller companies. Now, financial sector always does well, also does well when yields go up because they're they will profit margins expand as rates climb. So that helps banks, insurance companies, brokerage firms, money managers. Insurers, um, actually, they hold a lot of cash to pay out possible um, clients if there's an accident or something. So they get paid for holding that cash. So the more interest rates go up, the better their yield is on this short-term cash that they're holding. Okay, so it's yields are negative for high yields are negative for small caps, heavily indebted stocks, because you have to refinance and borrow money as the rates are going up. And that reduces your profitability and growth. Um, it's also negative for high yielding stocks, utilities, healthcare, consumer staples, because the demand, if you have a sure 100% guaranteed investment like the US Treasuries, and you can earn less for stocks or um, utilities that actually pay a dividend, you're going to choose the sure thing. That's why high yielding stocks with tendency to go down as interest rates go up. Home builders, the cost of mortgages payments go up as interest rates go up. So that makes less people want to buy houses, and that reduces their profitability. Um, and also speculative, non-profitable companies that need to borrow money, um, the cost for refinance or borrow money to grow their company goes up. So that's another reason, another type of company that does bad. And REITs, demand for high yield goes down when guaranteed yield goes up. So let's look at that in context. So we're going to look at the market movers. Okay, so rates are going up. That's bad for home builders. Let's see if that happens here. Let's look at the sectors. So let's sort by things go up and down. The bank ETFs. Okay, so we expected it to be positive for the financial sector. What's happening right now is we had earnings come out for some of the banks and they were bad, such as there was a small regional bank that did bad today. So that's why it's probably down. Um, home construction, as interest rates go up, it's negative for home builders. Okay, so that makes sense. Let's look at home builders. Financial sector. Okay, well, we expected the financial to do good as interest rates go up. Let's see. Utilities, as interest rates are going up today, so utilities would go down because the demand for yield goes down as risk-free treasury yields go higher. And consumer staples, all right, these are high yielding stocks. Okay, healthcare is high yielding. Let's look at the ones doing good. Semiconductors, oil, and telecom. So semiconductors, rising yield is positive for large tech stocks. Okay, so let's go back and look at this. All right, so let's look at some more of these stocks that are going up and down today. We have we have Mohawk Industries. They do a lot of materials for houses. So as interest rates go up, less people are going to want to buy houses. Um, Colgate-Palmolive, they had earnings come out that were better than expected, and they went down. T-Mobile, it went up a lot yesterday, so it's just recovering from that run up. And that's like McDonald's. They had a scare, um, a E. coli. People are dying from and getting sick from eating quarter pounders. So that's really going to affect their stock. It's going to take a while for people to forget about that. All right. And what else can we say here? Okay. Let's look at some of the other talking points we have here. Okay, we're going to look at Dan Now's picks from the beginning of the year. We have Amazon up 23%, Meta up 61%, Texas Instruments up 14%, XBI up 8%, and KWeb up 19%. So these have been pretty good. Meta has been the best performer. And actually, Meta is and Amazon are both going to be reporting next week. So let's see if they continue going up. We know that Meta is going to be doing better because I see ads every day on Facebook for political ads, and you got to know that they're getting a lot of money, and they're going to put their advertising in the Meta and Google. Right. So let's look at some of the earnings for this week. We had Verizon come out with earnings on Tuesday. We had Coca-Cola. Tesla had really good earnings on Wednesday. T-Mobile did better than expected, and we'll go over that later on today. And we also have Colgate-Palmolive. They had better than expected earnings, but they're going down today. Okay, so we're going to review what Jim Cramer, his explanation why money is going back into big tech. The interest rates are going up this week. So we have, let's see. Yeah, we have interest rates going up. So as interest rates go up, the investors are wondering why the bond yields are rising and what the implications of that is. Rising bond yields will help the big tech because big tech doesn't need to borrow money. They'll have a competitive advantage over their competitors. And okay, and rising yields hurt the companies that need to borrow, such as smaller caps and mid caps. We already went over this. The reason why rising yields on the 10-year are important to keep in mind when you're investing. Okay, here's an article. Paul Tudor Jones said the stock market reckoning on spending is coming after the election. We're going to be broke. And this is a dire warning from a hedge fund manager who is very successful. He actually predicted the stock market crash of 1987. He's been doing it that long, and now we hear from him that our country is in a big mess with its debt situation. I've been saying this for like all year long as one of my biggest fears. We keep on adding to our debt. The amount of money it costs to service it is increasing compared to our GDP. He does his approach to this situation is not to own fixed income. So if you bought a treasury right now and you held it, the 10-year treasury, you held it a year and interest rates go up, you're going to lose money. He said we're going to have a Minsky moment where all of a sudden there's a point of recognition that what they're talking about is fiscally impossible, financially impossible, and we might default on our debt. Now, the annual cost of the debt goes, the annual cost to maintain this debt goes up as interest rates go up. And if we have hyperinflation and some kind of higher interest rates. That could, like, a Minsky moment is a dramatic decline in asset prices. So right now with inflation, all asset prices are increasing, but I'm just saying this is pretty dire from someone who's really smart, who's predicted a prior crash in 87. So he said, in order to wade your way through this situation, you buy NASDAQ stocks, gold, Bitcoin, and short later dated bonds. He said the major point that he said in this article was all roads lead to inflation. So we're we're going to have to study inflation and how to protect our portfolio against that. I'm afraid I'm afraid that it's going to cost $100 for a banana, and the amount of money we're saving right now is not going to be worth anything in the future if things go the way they're going. Markets markets are also assuming higher inflation because Trump is going up in the polls. So that could be why there's an increase in interest rates right now. Okay, here's a chart of interest. We had Tesla report excellent earnings Wednesday. They went up 22%. And guess where that took us? To the top of this trading range we've been mapping out. So um, hopefully today we might be able to break through that, top of this trading range. And then we might have like an uptrend here. But as of yesterday, we were right at the top of this range. And you can see that we're super oversold. So that added to our why it would go up a lot. So okay, let's look at some more things. We did a screener, and the green is the top 25 of our 100 stock universe, and the yellow is the 25 to 50 best numbers in that category. So I was looking through this. T-Mobile has been in our list for quite a while. We haven't looked at it for a long time. They had better than expected earnings yesterday, and their stock went up. And I thought it'd be interesting to go through that again. Um, okay, so what I do is I mark the uh, best of every category, such as forward long-term earnings growth, and then I try to map out stocks like this one. Look, it's 43, 43, 172, 58, 41. There's a lot of green on here and a yellow, and you can see that's one way I map out some of the better stocks, just to see which one of these has the biggest numbers. Um, and then you just start researching each one to see if it has any credence. So let's look at that T-Mobile, just because we haven't looked at it for months. Um, T-Mobile analysts increased their forecasts for after strong earnings. Okay, so we know the theme is that T-Mobile is taking AT&T and Verizon's customers. They have better promotions on TV. They're giving away the iPhone, which helps. They're subsidizing the iPhone, which is helping Apple. And right now, it seems like based on their advertising, they're going to be selling a lot of these the newest iPhones. And the guy from T-Mobile actually said we're selling an amazing more than last year of the newest phones from Apple. So that's a good hint that Apple is going to be doing good. We're going to look at, and they have the best coverage for 5G. They're like light years ahead of AT&T and Verizon. Okay, so let's look at their fundamentals, their earnings estimates. They're scheduled to grow around 19% if you average all these out. So 35%, 14, 19, 13. So their PEG ratio is about 1.1. So they're overvalued by about 10%. And what we're going to do is we're going to look at other ways to verify that. What I like to do, I like to look at PEG ratio of 1.1. That's 10% overvalued. I'll wait for this to go down to at least a PEG ratio of 1 before I'm interested in it. Um, I know we've been screening this for months now, and for the longest time, it's been a PEG ratio of zero point 0.9, zero point 0.8, zero point 0.9, and you can see it's going up and it's getting to a point where it's over its PEG ratio now. So PEG ratio of 1.1. So now it's not time to buy. It's time to just watch it. Let's look at some of the fundamentals. Its market cap is 271 billion. They have net cash right now. So no, they had to spend a lot of money to buy Sprint and Spectrum and a lot of other things. So this is a very capital intensive business. So they're what we want to see as investors, we want to see this debt being paid down over time. So every year we're looking at this. We want this net 100 billion in debt to go down so that they don't get into financial problems. So right now you can see that the total debt is 116 billion, cash is 10 billion, so that's a net 106 billion out of 271. That's not that bad compared to AT&T and T and Verizon. But we know that you got to spend money to maintain the lines, to maintain the infrastructure. So it's a capital intensive company. Um, and it seems like a lot of the big tech stocks are turning into capital intensive companies also. For instance, Google used to be, they just paid for servers, which were pretty cheap, and paid for people to monitor all of the servers. And that was a good business model, but now they're capital intensive, much like phone companies, where you got to buy these very high priced NVIDIA processors. So that's going to affect the profitability eventually of those companies. Okay, so this high debt is something to be concerned about. Their profit margin and return equity is on the low end, but it's still acceptable. And the PEG ratio, of course, is around 1, 9.95. So Yahoo Finance thinks that they're growing around 21%. All right, that was a good excursion. I like to read, this is a CFRA report. They have a strong buy on T-Mobile. So that's a really good indication if they have a strong buy. But they also give this little excerpt of why, of their rationale. So this is important. Our strong buy recommendation reflects our expectations that T-Mobile will continue to outgrow their peers. We expect competitive pressures to remain fierce, but positively view free cash flow growth potential and churn. Okay, so their 5G network is at least 12 months ahead of Verizon and AT&T. It has enabled it to capture market share while competitors struggle to keep up, often resorting to promotional activity such as free iPhones. And T-Mobile continues to raise its merger. So they bought Sprint, and they're making they're bringing that into their company. And as they do that, they're improving the efficiencies. It's called synergy, and that's going to help on as they do this merger synergies. They're going to be more effective, and their profit margins will go up. All right. So I love these little summaries. Now let's look at the fair value. They actually agreed with Yahoo. No, they agreed with us that it's overvalued by about 10%. So that means we got a formula that works. We got a formula that currently predicts, the fair value of a stock pretty good. So we'll wait for this to go down 10% before we're interested in it. I looked at the revenue on this report. You can see it's going up in a straight line. That's what you want to see in a growth stock. You can see between last year and this year, the revenue didn't go up. That's something that I wonder about. But in general, they're scheduled to grow at 21%, which is pretty good for a telephone company. And they pay a dividend too. And you can see the net income is going up basically in a straight line too. So that is very comforting. Okay. Return on equity, it seems like it's getting better over time. It's not very consistent, but it should be okay. Now, Morningstar, they also say that it's 13% overvalued. So we have a formula that was confirmed by Morningstar and by CFRA. So whenever it gets down to maybe 195 or lower, that will be a time where it'll be fair value. All right. So that is what I had to say for today. Um, I hope you had a really good investing week. I hope your next week is going to go really good too. And if you have any questions, let me know and I'll try to include it in the next recording. All right. Have a good week, everybody. I'll see you next time.